Have you ever wondered why some investors make millions from a stock, while others lose money buying the exact same company? The difference isn't always luck. It's usually because smart investors pay attention to warning signs before everyone else does. And today, we're talking about one of the hottest AI stocks in the market, Supermicrocomputer, or SMCI. There's no doubt this company has been one of the biggest winners of the AI revolution. Demand for AI servers has pushed SMCI into the spotlight, and many investors believe this is only the beginning. But here's the problem. When everyone becomes bullish, very few people stop to ask one simple question. What could go wrong? That's exactly what we're covering today. These aren't reasons to panic or sell your shares tomorrow. They're simply 5 risks every smart investor should understand before making their next decision. So let's jump straight into it. Warning sign number 5. Extreme volatility. SMCI is not a slow-moving stock. It's common to see the share price move 8%, 10%, or even more within a single trading day. If you're a long-term investor, these swings might create buying opportunities. But if you panic every time your portfolio turns red, this kind of volatility can force you into making emotional decisions. Before buying SMCI, ask yourself, can you handle big price swings without panicking? Now let's move to warning sign number 4. Wall Street's expectations are extremely high. SMCI isn't just expected to grow anymore, it's expected to deliver outstanding results every quarter. That's dangerous because even if the company reports strong earnings, the stock could still fall if investors expected even better numbers. In today's market, expectations often matter just as much as results. That's why every earnings report has become a major event for SMCI investors. And now, here's a warning sign that many retail investors underestimate. Warning sign number 3. Growing competition. The AI industry is expanding rapidly, and SMCI isn't the only company benefiting. Major players like Dell, HPE, and other server manufacturers are investing heavily in AI infrastructure. More competition could mean lower profit margins, pricing pressure, and tougher battles for market share. SMCI still has strong technology and partnerships, but staying ahead won't be easy. So here's my question for you. If you had $10,000 to invest today, would you put it all into SMCI? Or would you diversify into other AI stocks? Let me know in the comments because I'd love to hear your opinion. Now let's look at the 2 biggest warning signs that every SMCI investor should keep an eye on. Warning sign number 2. Growth has to stay strong. One of the biggest reasons investors love SMCI is its incredible growth, but that's also where the risk begins. When a company grows this fast, Wall Street expects that momentum to continue every single quarter. If AI spending slows down, customers delay orders, or large cloud companies reduce their infrastructure budgets, SMCI's revenue growth could slow. And even if the company remains profitable, a slowdown in growth can still send the stock lower because the market always looks ahead, not behind. That's why every earnings report and every piece of guidance from management is so important. Now let's move to the biggest warning sign. Warning sign number 1. Market sentiment can change overnight. Sometimes a stock falls even when nothing is wrong with the business. Why? Because the overall market changes. Interest rates, inflation, global events, or simply investors taking profits can quickly push high-growth AI stocks lower. SMCI has become one of the market's favorite AI stocks, which means it can also become one of the first stocks investors sell when fear enters the market. That's why smart investors don't follow hype. They follow the business. Here's my personal opinion. I believe SMCI still has strong long-term potential because demand for AI servers isn't disappearing anytime soon. The company has built an important position in one of the fastest-growing industries in the world. However, I also believe investors should expect continued volatility. This isn't a stock that moves in a straight line. There will likely be sharp rallies and sharp pullbacks. If SMCI continues reporting strong earnings, expanding its customer base, and maintaining healthy profit margins, I wouldn't be surprised to see the stock trade higher over the next few years. But if growth slows or management disappoints investors with weak guidance, the share price could face significant pressure. That's why I think patience and proper risk management are just as important as picking the right stock. Now I want to hear from you. Are you buying SMCI at current levels, holding your shares, or waiting for a bigger pullback before investing? Leave your answer in the comments. I read as many of them as I can, and I'd love to know your strategy. If you found this video helpful, don't forget to hit the like button, subscribe to the channel, and turn on notifications because we regularly cover high potential stocks like SMCI, NVTS, IBRX, PLTR, and many more. Thanks for watching. Stay informed, invest wisely, and I'll see you in the next video.